Welcome to StokTok's deep dive into Spotify technology. Spotify is a digital music and podcast streaming platform that generates revenue primarily through subscription fees and advertising. As of April 30th, the stock is trading at $445.73. Over the past 52 weeks, the stock has ranged from a low of $405 to a high of $785. Right now, it's trading below its 50-day moving average of $499.67 and well below its 200-day moving average of $593.06. The Relative Strength Index, a momentum indicator, sits at 34.8, suggesting the stock has pulled back meaningfully from recent highs. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Spotify operates a freemium and premium subscription model for music and podcast streaming. The company's primary moat comes from its massive user base, which drives network effects for artists, creators, and advertisers, combined with a machine learning recommendation engine that keeps users engaged. The platform has expanded beyond music into original podcasts and audiobooks, creating a sticky, integrated entertainment ecosystem. Revenue comes from two sources: subscription fees from premium members, which generate high-margin recurring revenue, and advertising revenue from free tier and podcast ads, which monetize the massive free user base. On our StokTok Score framework, Spotify scores a 71 out of 100. Breaking that down, Valuation is scoring 10 out of 20. The stock is not cheap. Financial health is strong at 19 out of 20. Profitability is solid at 17 out of 20. Growth rates are healthy at 17 out of 20. Smart money positioning, however, is a point of concern at just 8 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? Spotify is trading at a price-to-earnings ratio of 35.37 times trailing 12-month earnings. The forward price-to-earnings ratio, based on consensus analyst estimates for the next 12 months, is lower at 29.48 times. This forward multiple is the more relevant one for growth investors, and at 29 times, it's above the broader market average but reasonable for a company growing revenue at the rates we'll discuss in a moment. The enterprise value to EBITDA multiple sits at 23.09 times. For context, the sector tends to see media and streaming comps trade between 15 and 30 times EBITDA, so Spotify is in the upper half of that range, reflecting growth expectations, but also pricing in the company's competitive position. The price-to-sales ratio is 4.58 times, meaning investors are paying $4.58 in equity value for every $1 of annual revenue. On a price-to-earnings-to-growth basis, the PEG ratio, the metric does not provide meaningful context here. From a discounted cash flow perspective, our analysis suggests the stock is currently trading at approximately a 0% margin of safety to intrinsic value, meaning the market is pricing the stock at or slightly above our fair value estimate with very little cushion. Wall Street analysts have a consensus mean price target of $601, with targets ranging from a low of $401 to a high of $750. That represents 34% upside to the current price at the consensus mean, suggesting the analyst community sees value from here, though clearly there's meaningful disagreement in the room. Now, let's talk about the competitive moat. Spotify's strength lies in scale. The platform has achieved critical mass in most developed markets, which drives both network effects for artists and valuable engagement data for advertisers. The company's recommendation algorithm is proprietary and difficult to replicate. However, the competitive moat is not impenetrable. Apple Music has deep integration advantages within its ecosystem. Amazon Music benefits from Prime bundling, and YouTube Music leverages video and advertising scale. In our view, Spotify's moat is defensible but not unassailable, which limits pricing power. Moving to recent earnings. In the most recent quarter, Spotify reported earnings per share of negative 42 cents, significantly missing the consensus estimate of $2.02. Revenue came in at $4.53 billion, notably missing the consensus expectation of $4.7 billion. Though we note this estimate appears to contain a data anomaly. Operating income was $710 million, and net income was $720 million, delivering a net margin of 15.51%. The earnings miss and revenue shortfall were driven by higher-than-expected content costs and a softening of advertising demand in certain geographic markets. However, the company maintained profitability and generated substantial operating cash flow. Market sentiment around Spotify leans decidedly bearish. Shares have declined 13% from recent highs, amid broader concerns about the company's ability to sustain operating leverage while scaling, combined with investor worries around artificial intelligence economics and their potential impact on music licensing negotiations. The bearish sentiment reflects both the recent miss and uncertainty about forward profitability in a competitive, cost-intensive industry. In our view, the stock is not cheap on an absolute basis, but relative valuation appears reasonable for a company with Spotify's growth profile and market position. The question is whether the earnings miss signals a structural profitability challenge or a cyclical headwind. Moving to financial strength, how solid is the foundation? The Piotroski F-score is a 9-point health checklist developed by accounting researcher Joseph Piotroski. It measures profitability, operating efficiency, and capital structure changes. Spotify scores an 8 out of 9, which is an excellent signal. The company is profitable, cash flow is positive, and the balance sheet has improved year over year. The Altman Z score is a bankruptcy risk model that weighs working capital, retained earnings, profitability, and solvency. Spotify's Z-score is 11.74, well above the safe threshold of 2.99. This puts the company firmly in the safe zone. Bankruptcy risk is negligible. Now let's examine the debt and liquidity picture. Spotify maintains a cash-to-debt ratio of 18.37, meaning the company has $18.37 in cash and equivalents for every $1 of debt. This is extremely strong. Interest coverage, a measure of how many times operating income can cover debt service, stands at 80.18 times. This means the company could theoretically cover its annual interest expense 80 times over with its operating income. Clearly, debt servicing is not a constraint. The current ratio, which measures short-term liquidity, is 2.06. This means the company has $2.06 in current assets for every $1 of short-term liabilities. A ratio above 1.5 is considered healthy. Spotify is well above that threshold. Finally, the debt-to-equity ratio is 0.06, meaning the company finances its operations almost entirely with equity capital rather than debt. This is conservative and reduces financial risk dramatically. In summary, the balance sheet is fortress-like. Spotify has minimal debt, abundant cash, and strong profitability. Financial distress is not a concern here. Management has constructed a capital structure that prioritizes flexibility and de-risks the business significantly. Next up, profitability. Is this business actually making money efficiently? We'll start with return on invested capital, or ROIC, a metric that shows how much profit the company generates for every dollar of capital deployed in the business. Spotify's ROIC is 36.99%. That's exceptional. For context, the cost of capital for a scaled technology platform like Spotify typically ranges from 7 to 10%. Spotify is generating roughly 4 times its cost of capital in returns, which demonstrates the power of its business model and the efficiency of its underlying assets. Moving to the margin stack, gross margin is 32.32%. This represents the profit remaining after paying for streaming rights and platform infrastructure costs. A 32% gross margin in a music streaming business is solid. It reflects the company's ability to negotiate favorable licensing terms while maintaining efficient platform economics. Operating margin is 13.72%. This is where we see the impact of operating expenses like sales, marketing, and technology development. The company is taking roughly 13 cents of profit from every dollar of revenue after all operating costs. Net margin, the bottom line, is 15.51%. This jumped significantly from the prior quarter, driven by the company's ability to maintain revenue while controlling costs. Free cash flow margin is 18.09%, meaning the company converts 18 cents of every revenue dollar into actual cash flow available to shareholders. This is strong and demonstrates that Spotify's profitability is real cash profit, not merely accounting profit. The margin profile is healthy and indicates that Spotify has achieved sufficient operating leverage that profitability expands as the company scales. In the most recent quarter, net margin expanded to 15.51% despite the earnings miss, which suggests the company is maintaining cost discipline even in a softer demand environment. The data points to a business that is efficiently converting revenue into profit. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years stands at 17.4% compounded annually. Over the trailing 5 years, growth is 13.1% compounded annually. This deceleration from 5-year to 3-year growth rates is worth noting. The company is growing faster recently than it was on a 5-year average, which suggests either acceleration or recovery from an earlier slowdown. In context, most mature streaming platforms are growing in the single digits. Spotify's 17% 3-year growth is solid for a company of its scale. Book value, the accounting value of shareholder equity, has grown 53.3% over 3 years, outpacing revenue growth significantly. This reflects the company's ability to reinvest profits and expand the equity base. However, the recent earnings miss raises a question. Is revenue growth sustainable, or are we seeing cyclical weakness? In the most recent quarter, the company faced softer advertising demand and higher than expected content costs, which pressured profitability. Management guided for moderation in growth rates going forward, though absolute growth remains positive. Dividend yield is 0%. The company does not pay a dividend. This is typical for high-growth technology platforms that reinvest all profits into the business. The growth profile is respectable for a company of Spotify's size and maturity. That said, the deceleration from peak rates and the recent earnings miss suggest that the company is contending with real competitive and cost headwinds that may constrain growth rates over the near term. Now let's talk smart money. What institutional capital is actually doing with this name. Based on the latest institutional holdings data, 23 top-tier investment managers, the so-called gurus tracked by institutional capital databases, currently hold Spotify. Of the institutional investors who file 13F holdings with the SEC, only 7.4% are net buyers of the stock, meaning they increased their positions over the latest reporting period. For context, a healthy signal would typically show 50% or more of filers being net buyers. At 7.4%, this suggests institutional capital is either indifferent or slightly reducing exposure. Let's look at the top holders. Chase Coleman's Tiger Global Management holds the stock as 2.47% of their portfolio, with no change in their position. Daniel Loeb's Third Point holds 0.8% of portfolio and is a buyer. They added to their position. Poland Capital Management, a long-term value investor, increased its position by 547.02%, a significant buy signal suggesting they see value at current levels. Thomas Gaynor's Markle Group holds 0.12% with no change. Stephen Mandel's Lone Pine Capital holds 0.08% and is a buyer, so we have mixed signals from the Guru community. Some buying, some holding steady, but overall confidence does not appear overwhelming. Insider ownership is 0.0%, which means that the company's executives and board members own effectively no equity in Spotify. This is a red flag from an alignment perspective. When management owns no skin in the game, they lack personal incentive to drive shareholder value. Over the last 3 months, there have been 0 insider buys and 2 insider sells, further suggesting that insiders are not confident enough to be buying shares, and some are liquidating. The smart money picture is decidedly mixed. While some value-oriented investors like Poland Capital see opportunity, the overall picture of Guru Holdings, 13F positioning, and insider activity suggests that institutional capital is cautious on Spotify. And finally, the verdict. Let's bring it all together. On valuation, the stock is not inexpensive at 35 times trailing earnings and 29 times forward earnings, but analyst targets suggest 34% upside, implying the market may be discounting near-term risks beyond fair value. From a financial strength perspective, the balance sheet is fortress-like. Minimal debt, abundant cash, and strong liquidity provide significant downside protection. Profitability is excellent, with ROIC of 37% and net margins of 15.5% demonstrating strong unit economics. Growth is solid at 17% three-year revenue growth, though recent earnings showed pressure from content costs and advertising softness. Smart money positioning is weak. Insider ownership is zero. Recent insider activity shows selling rather than buying, and only 7% of institutional filers are net buyers. The most recent quarter delivered an earnings per share miss and revenue shortfall, suggesting that near-term headwinds are material. The company faces content cost inflation and advertising cyclicality that are pressuring profitability. In our view, Spotify is a well-managed company with a defensible market position and excellent financial fundamentals. But the combination of lofty valuation multiples, weak institutional positioning, zero insider ownership, and evidence of near-term margin pressure creates a setup that warrants caution. One might argue the case for the stock based on long-term competitive positioning and the coming opportunity in podcasting and audiobooks, but near-term catalysts and market sentiment are decidedly negative. We would want to see either a stabilization of margins or a meaningful reset in valuation multiples before raising conviction. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Spotify technology. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.